Good morning. It's Jeffrey Christian of CPM Group. It's 10:55 in the morning here on Tuesday, August 13th in New York. I want to talk today about gold and silver investment demand trends. I spoke a lot about central bank activity, which central banks are buying gold, which central banks are not buying gold, knocking down some rumors about various central banks buying gold in Friday's video. And I want to focus on investment demand this week, today. So I will talk about that, and at the end of the presentation, I will talk about the market our market outlook. I should also talk about the fact that we had the U.S. Producer Price Index released today. We'll have CPI tomorrow, which will be perhaps more important to the markets. But the PPI, we had a 3.3% year over year, excluding food and energy, which is pretty high. 2.2%, including food and energy, because energy prices fell very sharply last month. But 3.3 excluding food and energy, 0.3% month to month. So there are still inflationary pressures that the Fed will be watching. A little cautionary note, because there's been so much enthusiasm and expectation that the Fed will definitely cut interest rates in September and possibly even do it on an emergency basis sooner. Not quite sure about that, and I'm in the trenches watching to see what happens. I think the Jackson Hole conference that the Kansas City Fed puts together in late August will be very important and telling. But this higher PPI today, and we'll see what the CPI is tomorrow, could affect the markets. So that's there. And then, as I said, I want to talk about the market outlook at the end. In the comments to our central bank piece last week, I said that the Fed does not care about gold prices in that presentation, and as one fellow said, why is the Fed short gold on COMEX if the Fed does not care about gold prices? I'll respond to that at the end of this presentation. The answer is very clear, and I think most viewers of CPM Group's videos knows the answer, but we'll get back to that. I want to talk about investor demand for gold and silver. Investors are buying large amounts of gold around the world. We saw 24, 25, 26 million ounces a year of net physical demand over the last 3 years. This year, it's probably going to be 30 or more than 30 million ounces. That's a very high level, as you can see from this chart. And it reflects strong investor interest around the world. People ask us, who's buying the gold? And with a couple pockets of exception, it's pretty much universal. We're seeing strong demand, not just in China and India, but we're seeing strong demand for gold throughout Asia, throughout the Gulf region, the Middle East, Europe, Canada, the United States, Latin America. People around the world are worried about the political and economic situation. They're feeling that the stock market, at least in the United States, is very top-heavy, and they're buying more gold and more silver to protect themselves from potentially adverse economic and political moves. And it's institutional investors, high net worth individuals, ultra high net worth individuals, family offices, and retail investors. Pretty much universal concern about the state of the world or state of your local situation, buying gold, and to a lesser extent silver. Investors have turned into net buyers of gold via ETFs. This really is a phenomenon that emerged, I believe, in April. Over the last 3 years, 21, 22, 23, investors were net sellers of ETFs. But when the gold price started rising in April, they shifted and they have become net buyers of ETFs. ETFs are the fastest way to buy either price exposure to gold as the price rises. People were jumping into the market, or to buy physical gold. And yes, it is physical gold. In July alone, the top 5 gold ETFs added about 641,000 ounces to their holdings. And if you add the other, I think we have more than 22 ETFs that we track in gold, it was about 932,000 ounces. Year to date, all of these ETFs have added about 2.4 million ounces to their holdings. So you're seeing demand for gold in the ETF market. Some of that's institutions, but a lot of it's retail investors. And investors now have 111.5 million ounces of physical gold that they own and hold through ETFs. So that's pretty strong. The pocket of weakness that we're seeing the most is the U.S. Mint gold coin sales. They're off about 62%, and you can see it's been pretty much across the year. And you can see, last year in March, April, May, the Mint was selling 280,000, 230,000, and 132,000 ounces. This year, they're selling a fraction of that. To some extent, that reflects the higher price. Investors are buying less gold coins at higher prices. The higher prices also have caused other investors to take profits and sell their coins. So those coins have come back into the market, not from new coin sales by the Mint, but from old coin sales, or what we call secondary sales, by investors. And that means that the coin dealers don't have to buy new gold coins from the Mint. Additionally, there could be some issues at the U.S. Mint that are restraining it. But the bottom line is that we've seen this weakness. We haven't seen this weakness in other coin sales, and we're not quite sure why the difference is there. There could be a complex set of factors that have contributed to this. On the COMEX, you're also seeing investors holding larger long positions, more long positions, and fewer short positions on the COMEX. You can see that the short positions, have gone from 15 million ounces down to less than 5 million ounces. And the long positions have gone from about 25 million ounces to more than 32 million ounces, spiking up to about 35 million ounces. These are institutional investors, gold futures and options. Turning to silver, a little bit different. We have very low net investment demand last year for silver and projected again for this year. Investors are buying a lot of silver, but it's being offset by continued investor selling. Now, again, some of the price of silver has been stronger over the last 3 months, 4 months, and that has caused some investors to take profits. And then we have this continued sales of disenchanted investors, people who had bought silver at $30, $31, $32 back in 2021 because they were hearing from the soothsayers on the internet that the price was going to $75 or $100 or $750 or $1,000 in short order. And it didn't happen, and these people were sitting on coins at $30, $32 an ounce for a long period of time. Price came down, and it came down hard. And now that it's rising again, some of those investors are selling. Those sales of physical silver by investors are offsetting and masking the fact that other investors are in fact continuing to buy silver. And you can see some interesting trends. U.S. Mint coin sales are up 35% year over year through July. Now, part of that may be the U.S. Mint doing a better job at getting silver coins out, and part of it may be investor demand. As the price has shown some strength, investors are buying more silver coins. But the bottom line is that you are seeing stronger demand. This time last year, it was 11.8 million ounces, and the year before that, it was 11.5. In 2021, when you had all of the soothsayers hawking silver on the internet, it was 19 million ounces. This year so far, it's 16 million ounces. So it's up from 22, 23. Not as high as in the glory year of 2021, but it's there. Investors are buying silver coins. They're also shifting to being net buyers of silver via ETFs. They were net sellers of significant amounts of silver over the last 2 years, 22 and 23. And again, as with gold, you started to see investors buying more gold in 2024, especially since April. About 25 million ounces of silver added. And you can see, by the way, all of these charts and tables are either from our gold yearbook, our silver yearbook, or our August 2024 precious metals advisory. Silver ETFs have come down from that peak, but there's still about 987 million ounces of physical silver held in ETFs. Should point out that that's down, so that when people say it's not available to the market, some of it's clearly available to the market depending on the price. Investors have also increased their long silver positions on the COMEX, but they haven't decreased their short positions the way they have in gold. Now, part of that may be that institutional investors are going long silver, but maintaining a hedge against the silver price coming down, because the silver price has been weaker, and there are any number of people who expect the silver price to underperform gold in the meantime. So investors that are involved on the COMEX futures and options markets may be more cautious and hedging their positions, which would keep those short positions larger than if they were getting out of their short positions and just going long. Going back to Leaf, the answer is very simple. The Fed is not short gold on the COMEX. The Fed has never been short gold on the COMEX, and the Fed doesn't trade on futures exchanges. The Fed, when it does trade currencies, and it hasn't done much currency trading in several decades, it trades in the OTC markets. So the answer is the Fed's not short gold on COMEX. Whoever told you that was lying to you, and you believed the lie. Here's the Federal Reserve Board's website. It's an incredible website full of all kinds of really good information about the Fed, how it works, who owns it, what the structure is, the tremendous amount of economic research that's produced not only by the 600 economists employed by the Federal Reserve Board, but also the thousands of economists that are employed by the regional Federal Reserve banks, as well as a lot of information about the domestic monetary system. You can learn a lot at federalreserve.gov, which will help you understand that some people who talk about what the Fed is doing don't know what they're talking about, or they do know what they're talking about and they just choose to lie to you. This is the Dunning-Kruger effect. The first time I heard about this, I thought this was a parody of pop psychology. And then I found out, no, it's real pop psychology. And the Dunning-Kruger effect is basically, if you don't know a lot, if your knowledge base is not very good, and your ability to think and discriminate good information from bad information is low, you may not know how low it is. Or the way some people put it is, really dumb people don't realize that they're dumb. Or they are people who are so unintelligent that they cannot comprehend and gauge how unintelligent they are. The flip side is that highly intelligent people often grossly underweight their intelligence relative to the rest of the world. And it all reflects the idea that the more you know, the more you realize you don't know. And the less you know, the less you realize you don't know. The world and everything else is very complex. Some people use the analogy of basketball. If you don't know a lot about basketball, but you're watching a game, you say, I can play that. But as you start playing and you join a team and you have a coach and you start learning about strategies and you start learning about positions and you start learning about setting picks for your teammates to take shots, you start realizing that basketball is a much more complex reality, right? And you can apply this to all sorts of aspects of human life. Just very interesting thing. The more you know about the Fed, the more you realize the Fed is an extremely complex institution. The more you know about monetary policy and fiscal policy and politics, the more you realize that there's a lot more to know. Everything that I've talked about today, all these charts are in either our August Precious Metals Advisory or our Gold Yearbook or our Silver Yearbook. All of them can be purchased individually at cpmgroup.com or by sending an email to info@cpmgroup.com. They can also be acquired as part of a retail investor program. Now, I said I'd talk about our view, our market outlook, and by that I'm sort of in our shorter outlook. It hasn't really changed from recent videos. With gold, we have been saying that we thought the price could trade between 2,300 and 2,500 over the course of August, and that we expect it to rise and rise sharply in the remaining 4 months of 2024 and into 2025. And that's predicated on hostile economic, financial, and political environments. We're maintaining that. We're at the high end of that range that we had set for August, $2,508 as I speak. The PPI came out. It was much more cautionary than the Fed's going to cut interest rates because inflation's coming down and that'll mean that precious metals rise. The CPI comes out tomorrow. If it reinforces the PPI's message, that could take the silver price back down and the gold price back down. So we have to pay attention to that. But our longer term view beyond the next couple of weeks is still that we think the prices will go higher, as has been the case for several years. With silver, the price has been weaker than gold. It has, gold traded in a range above 2,300 for most of the last 3 months. Silver has actually come down over that period of time. It shot back up. It got up to $32 or so last week. It's come off a little bit. It's $27.70 as I started this presentation. It's probably going to continue to appreciate. We do, as with gold, expect the silver price to rise sharply later this year into 2025 and in fact possibly into 2026. And we are looking for record silver prices on an annual average basis and on an intraday basis during that period of time. That disenchanted silver sales we expect to dissipate, and the fresh long buying we expect to continue and accelerate over the period of time. Last week I mentioned we have updated our gold and silver 10-year projections, supply, demand, and prices between now and 2033 in 3 different economic scenarios. They are available from CPM Group in a variety of methods and price ranges. You can contact us at info@cpmgroup.com if you want to figure out a way that works within your budget and your research and analytical needs. You may go to CPM Group's website. There's a lot of free reads. There are videos. There are reports that we do for ourselves and we give to our clients. There are reports that we do on a white label basis for other for companies that distribute them to their clients, and then we post them on our website. And you can write to us at info@cpmgroup.com and ask us about what's going on. That's all I have for now. I'll see you on Friday. In the meantime, take care of yourself and those around you. Do something good for the world, and visit federalreserve.gov. It's interesting reading.